Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Vislink stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vislink develops and distributes advanced communication solutions. It provides reliable connectivity even in the toughest environments during live productions like news broadcasts and sporting events, also for military surveillance and government work. It has offices in 5 countries and 137 distribution partners throughout Europe, US, and Asia. The company offers amplifiers, antennas, receivers, transmitters, and wireless camera systems. It sells its products all over the world. Let's get started with the model. This is a micro cap company, 187 million market cap. They're trading at $4 a share and they have 46 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. So the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. Revenue is the sales for the company, and that was $48 million in 2017, but cut in half in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Some examples are cost of labor and cost of materials. The difference between those two numbers is their gross profit. Their gross profit peaked in 2018 at 18 million, but it's about 1/3 of that number at 6.2 million. Below that is operating expenses. Some examples are marketing expenses, insurance, or depreciation. Then below that is operating income, and the company has negative operating income every year. Below that is the interest they pay in their debt, and then other income and expenses. This is usually impairments or non-operational gains and losses. The bottom line of the income statement is their net income, and that's negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. So the company has negative free cash flow every year. In order for them to run their business, they need to issue stock or issue debt. In 2017, they issued $7 million of stock. 2019, $16 million. In the trailing 12 months, $17 million. When a company issues stock, it dilutes the current shareholders, making your shares less valuable. It appears they issued a similar amount of debt as they paid off, so they're not adding any more debt. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. This company has negative operating cash flow every year. You could think of operating cash flow as net income converted to cash because net income is your accounting profit and loss. It's not actual cash. And the way you calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. You have to add 2.4 million of depreciation. That's a non-cash expense that brings down your net income. They also had a $4.5 million asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So it brings down your net income, but we have to add it back here on the CFO section. They also had $1 million in stock-based compensation and negative $7 million in changes in working capital. So even though they reported a $14 million loss, they actually lost $13 million of cash flow. Let's look at the capital structure. $13 million of equity, $2 million of debt. So they're 85% equity, 15% debt. And their WACC is 13.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $955 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $465 million. We divide that by 46 million shares. And we get a calculated stock price of $10.17. They're trading at $4.09, so they're trading at a 60% discount. It's a buy according to the model. This is the stock price the last 5 years. It appears the stock price was over $1,000, but it was never that high. It only appears that high because they did a 1-for-10 reverse stock split in 2019 and a 1-for-6 reverse stock split in 2020. So you would have to divide these numbers by 60 to get the true value on those dates. This is the stock price the last 6 months, and you can see the stock has done really well, especially in the past month. Investors really like this stock for some reason. And their beta is 1.46, so the stock moves 1.5 times the market. The stock has gone up 258% in the past 52 weeks. Much better than the S&P 500, which went up 17% in the same time frame. The 52-week low was 66 cents. The high was $9. The stock is trading well above its 50-day and 200-day moving average. This is a really liquid stock. 10 to 39 million shares are traded each day. And of the 45 million shares outstanding, 21 million are on float. And it has a really high short percentage. Almost 20% of the shares are shorted. So maybe there was a short squeeze recently which drove the price up. If you invested $10,000 when this company IPO'd, you could have sold at over $120,000 at one point. But if you held on, you would have been down to $1,000 today. Their biggest shareholder owns 6.5% of the stock, then Iroquois owns 2%, then BlackRock, Vanguard, and another company owns less than 0.1%. It is really difficult valuing a company with negative free cash flow every year. There is a good chance they will go bankrupt. My model is assuming they will not go bankrupt and they will become profitable after 2024. This is a really big assumption because anything can happen in the future. It's really hard to predict the future with a company that has such weak financials. But I do think there's a better chance of them going bankrupt than them becoming a $10 company in the future. The $10 is the most conservative estimate. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 7.6. So investors are paying $7.60 for $1 of sales. Price to book is stock price over book value per share. They're at 14.2. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. Negative net income, negative ROE. Current ratio is current assets over current liabilities. They're at 1.3, so they can cover their current liabilities. These current assets are as of their last published balance sheet. So according to my calculation, it does appear they're underfunded because they had negative 13 million of free cash flow and 4 million of working capital. But they recently did a stock offering of $50 million. So that will give the company a lot of cash to work with and keep them in business for at least another year or two. The only benefit of investors driving up a stock price is that a company can do a stock offering at the higher stock price. The best way to look at ratios is to compare them to similar companies. I've done videos on Ciena, Ceragon, Cisco, Ericsson, Hewlett-Packard, Lumentum, Motorola, and Nokia, all in the same industry as Vislink. And if Vislink has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they have a big negative. They do have the worst price to sales ratio of all the companies. They have a positive price to book ratio. The average is negative. Their current ratio is above 1, so that's good. They have a terrible ROE. They are lower in debt than the average, and they're the smallest company on this list. So to summarize, I have them trading at a 60% discount. This company has really struggled over the past few years, but they do offer a product that's very important. If the CEO can turn things around, they could become profitable one year. Also, they've been around since 2002, so they probably know what they're doing at this point. and they have a good client base. I rank their free cash flows 1 out of 10 because they're negative every year. I rank their revenue 1 out of 10 because it's going down and it's pretty small. And I rank their ratios 1 out of 10. Overall, they're really weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.